Hi, this is Randy Finney with Right Side of the Chart, and this is a mid-session update for Wednesday, September 29th, 2021. This one will be quick, I promise you that. I just want to do one brief update on the equity market, show you a couple key levels that I'm watching, and one other chart that I've shared in the past, but I want to do a quick update on that one. Okay, as far as levels to watch, as well as a development worth noting, didn't anticipate this yesterday, but I noticed it, reviewing the charts after the close and again this morning. So the levels are again 360. That's that shelf. I added that on the daily chart here, support shelf. Pretty important level right there. On QQQ, you have that previous reaction low. You have quite a few other reactions there. A big old volume of price histogram bar right here. I don't know if you can make it out, but you have these bars that come out all the way here, and then there's a big old thin zone in here where hardly any trades, relatively speaking, occurred at this point. So you had a breakout above that 340, 241, and which is still the next target, and I'm still leaning that way. But you got to break 360, as I often say. Support is support until unless broken. We already had a reaction off it once. I didn't think we'd have that much of a reaction on it again, and so far we had. That's what we hit yesterday. We traded on it yesterday. We've been trading on it all day today. So that just tells me, if nothing else, it tells me it is a very a significant level. It's a support zone that I had. You can see for many months. This is the purple lines, very important level. And again, we're bouncing. We've been consolidating on that since we hit it yesterday, and we're still there. Now, the development, okay, that's a level to watch. I still favor that it will go. Still favor a move down to at least T3. Again, that would be my next swing target. But we're going to have to take it out. We're going to have to, let's keep it very simple. We're going to have to take out yesterday's lows. You know, we overshot support by just a hair. And the development that I wanted to point out, I've got a lot of lines on this chart, but the one that I didn't really anticipate yesterday, I'm not crazy about it. Don't use emotions when it comes to trading. You try to keep that out. So for lack of a better word, I'm going to say I hate the fact we have this right now 60-minute positive divergence, but it is what I call potential divergence. Why do I say I hate that? You know, I'm short. I maintain that, yeah, I think we're going lower, and I think it's a good time to be swinging short. I don't think somebody asked yesterday if we'd get another reaction on that 360-ish level. I said, look, I don't think much of all, as far as time, it's only been since yesterday, and we're still not even halfway through the trading day, so it's not that much. And as far as percentage terms, the bounce is, negligible so far. It's minimal. We pretty much hit that level, and we're consolidating, and it also looks flaggish too. See that little, this looks like a bull flag pattern. So here's what I think is going to happen, and if it does, I think it'll happen this way. I tell you what I think. I make these micro calls, with a little more precision than most people usually try to make. So I think we break down. It's going to be impulsive. That would mesh with a bull flag scenario, because a bull flag consists of three components. An impulsive leg down, which is right there, followed by a period of consolidation. Typically, you want to see that on diminished volume. The volume has been diminishing a little bit. You can see since yesterday, that's what the volume looks like. And then you want to see a breakdown, and the measured target is the length of the flagpole added to the flag. And the move out of the flag when you get a breakdown is usually equally as impulsive as the initial drop. However, again, I'm just not a big fan of the fact we have 60-minute divergence, because during corrections in bull trends, which is right now 1000% what this is. Obviously, the primary trend is bullish. This is, so far, as I said yesterday, it's not even technically a correction. By technical definition, you have to drop 10% or more. And so we're only halfway there. I'm still looking for another 5% downside to give us that, just over a 10% drop from the highs if my third target's hit. Okay, so where am I going with that? Well, call it what you want, semantics, whether you want to call it a correction or not. It's certainly the biggest drop we've had in many months. And typically in a bull, where I was getting at is in a bullish trend, that's when I like to cover shorts and go long, is when we have positive divergence on the 60-minute chart, especially if and when one of my price targets are hit and we're at that support level. So look, I'll throw it out. I mean, anything's possible at all times. It doesn't. I don't even have to say that for you to know that. Anything in the markets, a sudden swoon down out of nowhere, a big rally. So it's very obvious that this market could go to new highs. Again, it doesn't take a rocket scientist to say that's a possibility, and even a decent probability because that's where the primary trend is. However, a couple things to note: we don't have what I call confirmed divergence. It's a little subtlety, but I like to say positive divergence is confirmed once you've effectively put in a lower peak in the or trough, that is actually in the MACD. That would be positive divergence by the PPO crossing over. That's this blue line right here. It's a PPO line. That white line's a signal line. So the PPO line would have to make a bullish crossover right there, and then you have a higher peak. Why? Well, because remember, these are momentum indicators, and when they're heading lower, they can continue lower. So it's when it curls up, and again, it's just a little technicality. It doesn't guarantee anything, but right now I just want to make clear this is only potential divergence. So that's why I'm staying short, not covering and going long like I might normally, because it's not confirmed. It'll be confirmed if and when we get a bullish crossover. And then on a final note, again, the fact that nothing's changed. If we break yesterday's lows and we do take another leg down, as I often say, fewer things are more bearish than a failed bullish setup. We're in a bull trend. Again, if I was longer term bullish and thought this market was going to go to new highs and quite a bit beyond, I'd be buying with both fists right now. This is the best setup we've seen in a while. This is the biggest dip we've seen in many months. So the bulls should be coming in with both fists right now. And if they don't, then it tells me simply that the supply-demand dynamics have shifted, meaning there are, at this point in time, more sellers in the market than buyers, or will be if the bulls can't, if they don't step in here and turn it up. So, when I say the bulls, the bears, it's metaphorically speaking, I'm talking about buyers. So if they don't step in, because this is where they should, and then it tells me things have changed, and I think it'll be a pretty swift ride down to my next target, that T3 at 343 right there. All right, so that's a lot. I just wanted to kind of get it all out to you guys. And again, it's simple stuff. Not at the risk of oversimplifying it, I think the trick will be a break of yesterday's lows. You can see that nice flagging action too in the SPY right here. Again, this is an impulsive thrust down, followed by a period of consolidation on declining volume, and the measured target would, it would take you down there. But I have SPY going a lot lower as well, or at least, what I say yesterday, another 5% or so. So not a whole lot lower, but again, another leg down. And one thing I do like, keeping me short, is a SPY. I also like to see that positive divergence ideally in both indexes. SPY it's not even close. Why? Because we didn't make a lower low. We have higher lows on the PPO and RSI on the indicators, but guess what? We do not have an equal or lower low on price. That's what we need to have bullish divergence on the S&P 500. All right, so I am going to bring it home with one chart, and we'll wrap the video up and keep it short like I promised. And that would be this one right here. Actually, I'll show you two versions of this, SPY and QQQ. Okay, I've talked in recent weeks, I've put out some videos in showing you that across the board, just about every breadth indicator that I track, and there are a lot of them, have all showed the same story. We have deteriorating internals in the market as the market has pushed to new highs, and I'm talking about the run up to the recent highs. We saw just about all the divergence on about all breadth indicators. Fewer and fewer stocks doing the heavy lifting, more stocks falling than rising, more trading below their 200-day moving average and their 50-day than above, et cetera, et cetera, et cetera. All right, the point is not to go over each and every indicator. I'm just going to pick this one right now. I'm going to center this chart so you can see what we're looking at. I'm going to show you, this is SPY daily chart. Here's your year break so you can get an idea. 2015, 2016, 17, 18, 19, 2020, and 2021 right there. And what I have here, let me change this tool. I'll make this red. Okay, I have the biggest corrections going back in recent years, the biggest drops in the stock market. This one back here, it measured roughly 15% from the high to the low. We actually had two 15% drops within there, and you went sideways. So it would have been a great time for longs to just get out of the market and put their money in the bank, or just not have that stress of going down. And it was also great shorting ops for bears or flexible traders, and great long. It was a sideways market for a couple years. Now it had a couple common traits, and I'm talking about, I have all the biggest drops in years. This one was about 20% right here. This one was about 36%. So this is a drop when COVID hit into the March lows. This is that big Q4 drop, which we caught almost all of that on the short side back in 2018, the fourth quarter of 2018. And this drop here was that mostly sideways market for a couple years back in 2015, 2016. Okay, what do they have in common? You can see this dotted line right here I have is when the peak came before those drops. So that's what those drops are measured from. And again, the three biggest drops in years in the market. They all had negative divergence on what we're looking at down below are two indicators. We're looking at the NAA 50R, that is the percent of stocks in the NASDAQ Composite Index trading above their 50-day moving average. And then down here, the NAA 200R. I've shared both of these indicators by themselves in recent videos, but I've had them now plotted against the market. So the NAA 200R is simply the percentage of stocks trading above their 200-day moving average on the NASDAQ Composite. And so it would only make sense. Those indicators, these are bound indicators. Some indicators like the PPO are not bound. An RSI is a bound indicator, so is this. Why? Because you can't have more than 100% stocks trading above their 200-day, nor can you have less than zero. So you're really not going to hit those levels, but you're going to get to extremes. And then the takeaway I like everything else, I look for divergence. So that's when the biggest drops in the stock market have occurred in the past. It's you have these common traits, and one of those is deterioration in the internals. So you can see here, leading up to the peak right here, you can see clear deterioration in the internals. Both the stocks trading above their 50-day and their 200-day were falling, while the stock market was still going up. And that's because, again, fewer and fewer stocks, namely those big fangs, the beloved, most widely held stocks, are doing most of the lifting, but the majority of stocks at the same time are falling. And that is, of course, always a bad sign. So you can see it there. You can see the divergences there leading up to that 20% or so drop. You can even see divergence on the percentage of stocks trading above their 50-day leading up to that big drop in COVID that, call it a black swan event, call it what you want, but there was already deterioration in market internals before it happened, and even towards the end there on the 200 as well. However, okay, so that's that, and here's where we're at now. We have comparable divergences. When I say comparable, I mean in scope. About for the same period of time. It's been about a year that we've been diverging on both these indicators. The number of percentage of stocks trading above their 50-day moving average has been falling, and pretty pronounced. Look at the drop. Same with the 200-day stocks trading above their 200-day. All right, we're going to bring it home with this one last line I have here. On the very bottom, if you look at the percent of stocks trading above their 200, you will see a red line there just below 50. It's about 40, 46 or so. And what I've noticed is when you're above it, it's that crossover down below. See, here was the top right here. Shortly after, we then crossed over and went down below there, and then that 15% drop and that other 15%. In fact, that other one came when we back tested. We started rallying, right? We rallied up to here, back tested that line right there, and then boom, another leg down. So in bull trends, you're typically above the line and even access support, right? Now you get little corrections along the way when you tapped it, but the biggest, again, here it is. Look at it this way. The biggest drops in years have all occurred, all three of them, 20, 36, and 15% times 2, have all occurred when we drop below there. And it just happened recently. This is you don't count these. Why don't I count these? Well, because we just had a 20-something% correction. I only count the breaks when we're clearly above it, like this, and then we break down below. Otherwise, you're coming back up. You're gonna cross through the line, and then you get in a bull trend. then it's that next drop down below once you clearly established a bull trend. Hope that makes sense. So, hey, look, nothing is 100%. Can you go bet the farm right now that we're going to have a much larger drop? But all this is speaking to, at least to me, is that, hey, there is the possibility for more than the 5% or so drop that we've already had, which hit my initial short-term targets at T2 level and QQQ, or the extra 5% if we get that next sell signal on the break of today's lows. This tells me that in the past, when you drop down below that level, it was followed by drops that averaged well above 20%. Okay, so that's that. And we'll just wrap it up showing you the QQQ pretty much says the same thing right here, that one right there. Well, something happened. All my lines moved, all my measurements moved. Let me make sure I don't have another variation of this chart. Hold on one second. Okay, well, it appears it didn't save my settings. I was, doing this earlier today, going through these charts. And what happens with stockcharts.com? That's the platform we're using here. When you change a time frame on certain charts, depending how you saved them down here, if we go from 7 years to 6 years or 10 years, sometimes it'll shift the lines, and that's what it did here. So it looks like all these were up to date. These got shifted. I also had updated the more recent lines, and I just wanted to show you. Bottom line, it says the same thing. We were diverging up to we've been diverging here on the 50-day percentage of stocks trading above their 50-day, and we've started from this point right here on the 200-day diverging. So there's our divergence right there, and it's sharp. It's very pronounced. You can see back here we had smaller divergences along the way. Again, I had cleaned this chart up and showed you just the major corrections. I've got the little ones measured out in here, but then everything shifted from this point, and everything I did here didn't save. But it's the same thing, and you have that same level down here where you break below the big drops. There was a 30% drop. You cracked below, you held support, 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 then you cracked below right here, and you had a 24% drop. Then you had a sell signal again there. Once you got above it, bull trend, that big drop when the COVID hit, and here it is. So this is again the first time in years we've had the percentage of stocks trading below their 50-day. Again, I also moved that line a little bit below 50. I had it 50 here, and again, all my changes didn't save. So that's that, and I'll wrap it up here. And again, it just helps to go formulate the bigger picture and showing how right now, I know things are as rosy as they've been in many, many years in the stock market. But one thing that I've always said and I maintain is that the headlines will follow the charts. Charts start to correct, the market corrects, all of a sudden you're going to start reading different headlines. And the thing is, they say Wall Street climbs a wall of worry, and my goodness, there's been enough, negative headlines in the last few years, especially last year or so, that just got shrugged off. And as I like to say, bad news is ignored until it isn't. It's kind of a yogiism, and that's what the market will do. Also, everything about the debt ceiling, Congress not, or Dems and the Republicans not agreeing on what to do, whether to kick the can down a little bit down the road, all these fiscal things going on, the Fed talking about tapering, and all that other stuff, which had been for a while. Again, it doesn't matter until it does. And then when it starts to go down, the Wall Street Journal and Bloomberg and even NBC and all that, they'll cite those as reasons the market are dropping. And again, all of that, most of that at least, is old news. So that's that. Anyway, sorry I didn't have this chart clear for you, but I think I did a pretty good job of showing you on the S&P. And again, this one, you can replicate these charts, not very complicated. Pull a chart of QQQ. I like to use log scaling, and then use those indicators. And that's, again, those are just two of many, many breadth indicators that I use, all saying the same thing: clear divergence, flashing, warning signs that that is not a healthy rally. It's certainly a profitable rally if you're long, but it shows that under the hood in the market, things are not as they normally should be. And in fact, they're just as they usually are towards the tail end of a rally. That's just how the stock market works. All right. Anyways, we'll wrap it up here. This has been Randy Finney with Right Side of the Chart. Have a great day.